Hey everyone. What if I told you that you don't need dozens of ETFs, stock picks, or complicated strategies to build serious wealth in 2026? What if just three simple, proven ETFs could cover nearly everything you need the same way they form the core of many successful long term portfolios? I've analyzed the top investing approaches, pulled real historical data, and these are the only three ETFs I believe most investors need right now. If you're tired of overcomplicating your money, smash that like button, subscribe, and let's break it down with actual numbers. Look, I used to be right, where many of you are jumping between hot stocks, watching my portfolio swing 20 to 30% in a month, and feeling completely overwhelmed. I would stay up late researching individual companies, constantly worrying about missing the next big thing. Then I learned a powerful lesson: simplicity beats complexity over the long run. The average investor underperforms the market by a huge margin, often 4 to 8% per year, mainly because of overtrading and high fees. That's why I completely changed my approach and built my own portfolio around just a few rock solid ETFs. Today, I'm showing you exactly why these three work so well and how they can work for you too. After digging deep into performance data, holdings, expense ratios, dividend yields, and tax efficiency, it's clear you don't need more, you need better. We're combining broad US market exposure, high growth innovation, and quality dividend stability. Let's let's go through them one by one with the real numbers so you can see exactly what you're getting. Number 1 is the True Foundation VTI, the Vanguard Total Stock Market ETF. The single ETF gives you ownership in over 3,500 US companies, large, mid, and small caps. You automatically own tomorrow's winners as they emerge without having to predict anything. Top holdings right now include Nvidia, Apple, Microsoft, and Amazon, but you also get the next breakout companies without guessing. Tech makes up a big portion, but you're nicely diversified across the entire American economy. Real performance data as of mid 2026. Over the past 10 years, VTI has delivered roughly 14.7 to 15.1% annualized with dividends reinvested. That means $10,000 invested 10 years ago would be worth approximately $37,000 to $40,700 today. Expense ratio, just 0.03%, only $3 per year on a $10,000 investment. Dividend yield around 1.3 to 1.4%, with a very high percentage of qualified dividends for better tax treatment in taxable accounts. I usually keep 50% or more of my portfolio here. This is your set it and forget it core that does the heavy lifting for long-term growth. Number 2 is your growth accelerator, QQQM, the Invesco Nasdaq 100 ETF. This holds the 100 largest non-financial companies on the Nasdaq, heavily weighted toward tech, AI, semiconductors, cloud computing, and innovation. Major holdings include Nvidia, Microsoft, Apple, Broadcom, and more. Why QQQM instead of QQQ? Lower expense ratio at 0.15%, and a more accessible share price for regular investors. Recent performance. In strong innovation years, it has significantly outperformed the broad market. Over the past 5 years, it's shown annualized returns around 17 to 18% in many periods. Yes, it comes with higher volatility, but that's the price you pay for higher long-term upside. I allocate 25 to 35% here. This is what turns good returns into potentially life-changing wealth. Number 3 is your anchor and income generator, SCHD, the Schwab US Dividend Equity ETF. This focuses on 100 high-quality US companies with strong fundamentals, consistent dividend growth, and solid balance sheets. These are not just any companies paying dividends, but businesses that have proven they can grow their payouts year after year, even during tough economic times. Current stats as of mid 2026, 3.3 to 3.5% dividend yield, expense ratio, a tiny 0.06%. and it has delivered strong total returns with lower drawdowns during market rotations. 1-0. Year annualized returns have been around 12 to 13% in many windows, with a focus on quality over pure growth. I typically allocate 15 to 25% here. It provides income you can reinvest for compounding or use in retirement, plus excellent tax efficiency on those qualified dividends. This ETF helps smooth out the ride when the market gets choppy, giving your portfolio that extra layer of stability without sacrificing too much growth potential. Here's a simple, effective allocation for most growth-oriented investors under 50. 50% VTI, 30% QQQM, and 20% SCHD. This mix gives you broad exposure to the entire US market, powerful growth from innovation and technology leaders, and reliable income plus downside protection from quality dividend payers. You can adjust the percentages slightly based on your age and risk tolerance. For example, if you are a bit more conservative, you might move to 45% VTI, 25% QQQM, and 30% SCHD. The beauty is that even with small changes, the overall strategy remains simple and effective. Let's run the numbers on a $10,000 initial investment with dividends reinvested and a conservative blended average annual return of 11 to 13% based on historical mixes of these ETFs. In 10 years, that $10,000 could grow to roughly $28,000 to $35,000 or more. In 20 years, potentially $80,000 to $120,000 or more from that initial $10,000 alone. Now imagine adding consistent monthly contributions of even just $200 or $300. You're looking at hundreds of thousands or even millions over decades. That's the real power of compounding at low cost. Time in the market beats timing the market every single time, and these three ETFs make staying invested so much easier. I know what you're thinking. What about international stocks or bonds? International has lagged the US for many years, though you could add a small VEA allocation later if you want extra diversification once your portfolio gets larger. Bonds make more sense closer to retirement when you need to protect your capital. These three ETFs are also very tax efficient thanks to low turnover and high qualified dividend percentages, especially important in taxable accounts. Always max out tax advantaged accounts like Roth IRAs first when possible. Another big advantage is rebalancing once or twice a year keeps things on track without much effort. Now, tell me honestly in the comments, how many ETFs are in your portfolio right now? Are you holding more than 5? Be honest. I read the comments. And if you're just starting, what's been holding you back? Is it fear of the market, not knowing where to begin, or something else? Drop your thoughts below. If this video gave you clarity and real numbers you can actually use, please hit like, subscribe, and turn on notifications. I'm committed to bringing you straightforward, data-backed investing content that cuts through all the noise. You don't need to be a genius or spend hours every day managing your money. Open a brokerage at Fidelity or Schwab, set up automatic investments into these three ETFs, and let time and compounding do the heavy lifting for you. These won't make you rich overnight, but they can absolutely make you wealthy over time if you stay consistent. Start small, stay disciplined, and watch your money work harder than you do. Thanks for watching all the way to the end. I'll see you in the next one. Go make your money work harder than you do. Take care.